Personal Trust business model is designed to look after our predominantly retired client base. Not only do we have a conservative investment management style, as a trust company, we specialize in trust and estate planning and often assume a fiduciary responsibility. We also have a money market where we structure our clients' cash investments and are able to make ad hoc payments from those investments as well as regular monthly payments. We employ 2 dedicated staff members whose role it is to provide care and compassionate support in times of need. We believe that we have a competitive advantage in the management of retirement capital. My trust officer colleagues and myself have lived through 2 stock market crashes, one in 1998 at the Asian crisis and the second one more recently in 2008. And we've faced our clients across the table when sometimes share markets have been down by somewhere between 30 and 40% because of our policy of diversifying across a whole range of different asset classes. And we've been able to help manage our client expectations through those times of crisis. In fact, we were delighted that the Personal Trust Managed Fund was awarded the Morningstar Award for the best aggressive asset allocation fund for 2016. The Personal Trust Prudent Fund has been in existence for nearly 15 years now. When we designed the fund, we set the benchmark at inflation plus 5%. And the history over the last 15 years suggests that the Personal Trust Prudent Fund has managed to outperform its benchmark, which is the CPI plus 5, over that whole 15-year period. We acknowledge that clients are unlikely to employ one manager or invest in one fund with their total retirement capital savings. Therefore, we have designed, alongside our managed fund and conservative fund, the Prudent Fund, which is a multi-managed fund for clients' preservation funds and retirement annuities. Personal Trust does not manage the assets. The assets are managed by top-performing fund managers. Our role is to select and blend these asset managers together to create one multi-managed fund solution for our clients in retirement capital investments. Our selection criteria when we come to invest in these funds is to look at the person managing the money, to look at the team behind that person, to have a look at the performance track record, but in addition to interrogate the assets within the fund, the shares selection, the bond selection, the offshore component of the fund. As investment managers, we're able to intelligently interrogate those investments and see whether they would be appropriate for our clients' retirement capital. One of the criticisms of multi-managed fund solutions is the cost. Because of the size of the assets that Personal Trust manages within the Prudent Fund, we've been able to negotiate with most of the managers competitive wholesale fee structures, which we then pass on to our clients for their benefit.
We've been asked to discuss what is unique about Prudential's investment philosophy and process. Firstly, at an asset allocation level, Prudential has firm valuation anchors with respect to what return we require from the different asset classes. This is best shown in the following slide, which shows that as we invest in more risky assets, as we move from cash onto bonds and onto equities, we require a high return for taking on the additional risk. Our asset allocation team effectively manages the exposure to these different asset classes by comparing the return that are offered in the market, represented by the red bars, to our required return, shown by the grey dots. Prudential is part of the wider Prudential PLC, one of the world's largest financial services groups with over 500 billion of assets under management. A second differentiator is therefore our ability to access some of the best worldwide resources and investment expertise to help our clients achieve their investment objectives. Lastly, at Prudential, we believe we understand the importance of position size, how much we invest in a single stock, sector or idea better than most. You can think of position size as the speed at which one travels down the motorway. There's a conservative speed, an aggressive speed, and frankly an insane speed at which one is more likely to have an accident. At Prudential, we set our overweight and underweight position sizes relative to our expectation of future returns. We therefore hold the biggest positions in those ideas where we expect the highest returns. While this may limit our ability to have a blowout year, it also protects us against a blowout and is in line with our promise to clients to deliver consistent investment performance over time. Because at Prudential, we believe consistency is the only currency that matters.
The standout and defining feature of Coronation's investment philosophy is our time horizon. For us, a long time horizon speaks to in excess of 5 years. 5 years typically captures the full value that a stock offers. The second key feature is that absolute commitment to valuations. I think most investors are forced into buying companies where the news is good and getting better. And I think that if you have the luxury and the privilege of the time horizon that allows you to buy undervalued assets where the news may not be so good this year, then I think you have an enormous advantage. I often say that there are many good buyers of stocks, but very few good sellers. It's never easy to sell a stock when you've been right. It's done incredibly well. Sentiment is strong. The share is consistently rising. Not easy to sell in that environment. And that is an absolutely key feature of our investment philosophy in our portfolios, that discipline to sell when an asset has reached a fair value and apply that capital now into other ideas, other undervalued, underappreciated assets. Coronation very much has one investment team. I think that silos become very dangerous. I think people lose perspective, dysfunctional behavior starts to exist between the silos. And we very much find that creating one team without offices, open plan, where on a daily basis people are discussing and debating and challenging each other from very different perspectives, which you get with the different asset classes. And within equities, with different regions, emerging markets, global equities, South Africa, we think that you end up with better portfolios at the end of the day. The borders and boundaries between markets are becoming increasingly blurred. Stocks are listed in many markets, and we think that that the value that we get from debate about technology across the globe, what's happening in China versus the US, what's happening in pharmaceuticals, the gaming industry, whichever industry it may be, we've got great value and insights from that process. And I think that if you put yourself in different parts of the world, you're not going to be able to achieve that same level of debate that you do if you're all together.
One of the things I think that are unique at Ale & Co is that we don't allow staff to invest in separate investments for themselves. They have to invest their entire wealth, plus their family's wealth, in our funds that our clients invest. And you know, when you start thinking like that, and you know your clients and your families and your friends intimately, you do tend to think a little bit longer about what you do with their money, because it's our money, it's not their money, it's not my money. And sometimes people don't want to work at Ale & Co because we eat our own cooking, and they want to buy their own shares, and that to me is not right. People like ourselves have earned our money the hard way, and our clients similarly, and why shouldn't we eat from the same table? And I challenge you to find an asset management industry company that does that. I don't know many. Hedge funds in the early days used to do that, and that's why they were so popular in the 60s and 70s. Today it's become quite blurred. And we don't have compliance issues, we don't have independence issues, because there is nothing to comply with. We just look after clients' money. And therefore our biggest risk at Ale & Co is doing what's right for clients, and they're not short-term, they're more short-term in their focus, and they take the money away. And we don't think like that, because that's our money, and over the years we've made money because we're patient. And the wonderful thing about investing is the more time you have, the less risk you have. And the less risk you have, it means high return, low risk, not high risk, high return, which is the conventional thinking that comes out of the universities. And just on that, I think the universities or the academics do us a great disservice, because investments, you don't need 4 years to understand investments, 3 months is enough. And if you just go back in the past and listen to people like Warren Buffett and Charlie Munger, you'll do just fine. The problem we have today is people spend more time on what holidays they want to go on and what car they want to buy than what we are doing with their money. And us at Ale & Co will happily always talk to clients if they want to, you know, what we're doing with our money, not their money. And that, after 10 years, has worked for us. And one of my colleagues the other day, we were talking about investment performance, and he said, but you know what, success is longevity. And we've gone through a lot of crises in this last 11, 20 years. and we're still around. And if that's the one message that I think what we do at Ale & Co is about longevity. It's about staying out of trouble.
The most important thing about the Alan Gray philosophy is the fact that we look long-term, look through the cycle to try and work out what businesses are actually worth based on their underlying ability to generate cash over long periods of time. This doesn't mean we only buy stocks trading on very low price to books or very low PEs, like some may think that the classic value manager. We far prefer to describe ourselves as valuation-based managers. We're trying to work out what businesses are actually worth and buy them when they're trading below that value and sell them when they move above that value. How do we do that? Well, we've got various metrics we look at. We try and normalize, we look for outliers. If the unsustainability of an outlier is in our favor, we look to take advantage of that. If something's unsustainable and adding risk, we tend to pull away from that and be very cautious to invest in something that we don't think is sustainable, that could lead to real losses for our clients. The philosophy of valuation and valuation-based managing applies to all our investments, whether that be the Alan Gray Stable Fund, the Alan Gray Balance Fund, or our equity fund. Looking at the Balance Fund, we actually start off with a clean sheet of paper and we build the portfolio from the bottom up, looking at businesses that we think are trading at below their value. We add that portfolio. We look for the next business that we think is going to give you, the investor, a good real return over time. We add that to the portfolio. And that's actually what drives the asset allocation. So it's very much the bottom-up view driving the asset allocation. This similar process drives the exposure to offshore assets, to property assets, as well as bonds and cash, trying to create a portfolio to give the best risk-adjusted returns over time. And that risk factor is exceptionally important to us. We take great measures to avoid losses for our clients. And for us, losses are not losses relative to a benchmark, it's actually real money losses that we're looking to avoid. This philosophy has put us in good stead over many cycles, whether it be the 98 tech bubble, which we managed to avoid, the 2007-2008 mining stock boom that we managed to avoid. Why did we avoid those? Well, we saw that those profits and those valuations that those companies were trading at were just not sustainable. So that's something we pull away from, and if need be, we'll pull back into cash or fixed interest to minimize your loss. So if I had to sum that up, I'd say what we're looking to do is avoid losses for our clients, generate good, sustainable, real returns for our investors over long periods of time through using the Alan Gray value philosophy.
The Investec opportunity is a multi-asset South African portfolio that invests in a variety of both local and international assets. Our aim is to try and provide returns which participate in good market conditions, and we try and avoid the significant losses of capital in difficult market circumstances, which do happen from time to time in the evolution of time in investment markets. We know that times are tough and sometimes they're good, but in essence, the way we achieve this sort of holy grail of good returns in good markets and avoiding the difficult returns in poor markets is through varying our asset classes through time, by investing in both equities and bonds, and also investing locally and internationally. The core driver of returns would always be equities, and the type of companies that we invest in is also important to understand. So philosophically, we believe in buying businesses that have superior characteristics and credentials, and those superior characteristics last longer than what most people think they will last. And it's this opportunity that we try and capture through the allocation that we make through time. It's fair to say that there are probably better and more number of great businesses outside of South Africa, but this doesn't mean that South Africa does not produce some exceptional businesses. So if you look at some of our holdings we've invested in over time, we've invested in tobacco companies. British American Tobacco has been a cornerstone of our portfolios for a long period of time, and we expect it to be in the portfolios for many years to come.
outside of any material changes in the price and the value equation. On the offshore side, there are also exceptional businesses to invest in which you cannot access in South Africa. So if you think of a company like Visa, which has the largest payment network in the world, it generates some of the most attractive margins, requires no capital to grow, and ultimately will deliver double-digit earnings growth for investors over many, many years. These are the types of businesses that we would want to invest in, and again, we're mindful of price. So in conclusion, this is a strategy which we think is timeless. It's a strategy that will work in a number of different market circumstances. It's not foolproof. We accept when we are vulnerable in terms of market circumstances and opportunities, but over time, the performance footprint we think will generate the type of investment results that is suitable for long-term investors that have a mind and an eye for long-term wealth creation.
In summary, Personal Trust's role is to select and to blend the various fund managers together in one multi-managed solution for our client, to negotiate the most competitive fee structures that we can on behalf of our clients, and to interrogate the portfolios that we put into the multi-managed solution to ensure that they are appropriate for our clients' risk appetite and their expectations of performance for their retirement capital.